welcome. I am Janita Stanton. We have Reginald Perriman, Shaka Williams. We are TSARE, and this is the There's Something About Real Estate podcast where we talk all things real estate. And tonight we have with us Jason from what company?
Marcus and Millichap, the biggest commercial real estate investment sales firm in the country.
What is? Say it again, Jason. Marcus and
Millichap.
Millichap. Okay.
So we have a team within the firm. We're based in Los Angeles. We sell primarily retail and net lease properties, which is a category of commercial properties. You got apartments, hospitality, office buildings, retail, and then kind of what I focus on, net lease properties.
Okay, great. And for our viewers, I have limited experience with commercial. I've done some commercial deals and actually leased some and purchased and sold some. But just explain what a triple net lease is and net lease is.
Yeah. So it's the simplest form from the landlord's perspective of ownership. If you have a triple net lease, and it's really net, each one of those nets equates to another thing. So one of those nets is maintenance, one of those nets is taxes, and one of those nets is insurance. So a net lease, or a triple net lease, is one where the tenant is responsible for all three of those things. In other words, you get a rent check, rest is on them. That's it.
Right. And that's more common in the commercial space, and when you see more like retail, well, pretty much all of it, right? On the higher end?
Usually it's most used when it's just one tenant. Okay. When you get into the multi-tenant retail strips, it's harder to have it because everyone has their own little share. And there's ways to get real close where the landlord has no responsibilities, but at the end of the day, because it's a small percentage, there's got to be someone that orchestrates, hey, you owe this much, you owe that much. When it's a single tenant, for example, anytime you see a fast food restaurant or a restaurant in general, Red Lobster, Carl's Jr., there's just a box with one person in there. Those are usually, if they're not owned by the person operating the business, those are owned by some random person in the country just getting a rent check. And the tenant, whatever business is operating there, they're taking care of everything. So it truly is, passive, if you will.
Right.
Until they leave, and then you got to figure out what to do with the box.
Right.
Right.
So you're calling it passive because you're saying you're doing as little as possible, so are you typically hiring a property manager?
No, this is as true as you can get to passive income.
Okay.
That you are doing nothing, but you have a set return. So there's no way to drive value in these typically. They're usually subject to really long-term leases with baked-in increases. So on years 1 through 5, you're getting $100,000. Year 5, you're starting to get $110,000. There's no way to go in and say, hey, you got to start paying more because I'm going to put a palm tree out front or anything like that, or you can't kick them out. 20 years usually is what you're set in there for. So it's passive, but that's your money. That's all you're getting.
Right. But it's a little bit more, it's a little bit more guaranteed in a sense compared to other forms of real estate investing, what you say?
Yeah, and usually you're getting a lower return when that guarantee is better. So the guarantee comes in the form of who the heck is your tenant. Your tenant could be Walgreens, which is a publicly traded corporation. You're probably going to get your rent check.
Right.
If you got a tenant in there, I got money, but if things hit the fan, maybe I stop paying my rent. I'm probably going to have to offer you a better return if I'm your tenant because I'm a little more risky than Walgreens is.
Right. Now, with the vacancy rates, when these properties do become vacant, is it because you said usually it's like maybe 20 years or so? Are the tenants typically making any value add improvements, or they just kind of just maintaining it to the minimum?
I mean, it's their business. So if you're talking about a fast food restaurant, they're going to be losing their money if they're not making this thing look as good as it can.
Right.
But, it's hard to say.
Because I see some, and I don't want to name a certain franchise, but there's
name it, because it's probably just the franchisee that sucks, not the franchise itself.
Okay. So like we seen like a lot of Church's Chickens that were where the buildings were not in the best shape, but then we start seeing them like combined with White Castle and that type of thing. But then the condition of those were a little better, or we see some that are maybe like inner city where they're a little bit more run down. And that's up to the actual tenant to maintain that. And it's really a business decision if they want to invest and make that place a little bit more attractive, correct?
Yeah, it is. And what it really boils down to, any of you lived in an apartment before? I'm sure. I mean, at some point, right?
An apartment?
Yep.
Yeah.
Yeah.
So, I mean, your lease is going to have house policies in the most simplest form. Some of them will say you can't make noise after 9. Some of them will say you can't make noise after 10. So you all know what a lease is, or anyone out there listening knows what a lease is. When it comes to these triple net leases, usually they're very thorough about what you can and can't do and what happens if you don't do those things you're required to. So in most of these triple net leases, it's going to say you got to maintain your building up to standards, whatever that is, and it's defined in there. And if you don't do that, you'll be penalized for it. But once again, every case is different. So if you give me an address, we can look at it, but it's not going to help me to tell you why or why not it looks good without actually seeing the lease, what the obligations are,
Okay. And these are longer terms because you're dealing with a business. They're trying to have like a stake and market share. So they're not trying to lease for 2 or 3 years. This is probably like a 10 or 20 year type situation.
Yeah, it goes both ways. The typical, like any big franchise brand, those leases will typically be 20 years with 4 or 5 year options. So if they're signing a lease at a building, they want to know that they can be there for at least 40 years. And typically they're the highest paying. So if they do exhaust that 40 years, if you're a landlord, you're probably going to want them to be there unless, of course, the zoning's changed, which means you have a better use for that property and you want them out. Or you have a tenant already ready to go in there that's going to pay more.
Right. What about those? When we see some of these places, like some of the restaurants, they'll actually probably like tear the building down and rebuild it. Are those typically owned by the franchisee or?
Yeah, I mean, I'll use an example of any major QSR brand, quick service restaurant brand. You got Wendy's, Popeyes, Carl's Jr. When you do a full remodel to the franchises, and when I say franchise, I mean the company that has given you the rights to use their name and sell their products. They usually have every 10 years, if not less than that, a new prototype for buildings that they think, based on their marketing department's knowledge, whatever, is going to perform better. Usually, when you upgrade to that, you're going to increase your sales by 30 to 35%. So even though it costs like $500,000 in some cases to tear your property down and build it up, you're going to make 30, 35% more on your product and revenue. So it's all calculation at the end of the day.
Okay, well, that makes sense.
And sometimes you're required to. The franchise is going to say, "Hey, we're going to revoke your franchise agreement, your ability to be in our system, if you don't make this improvement, because hey, you're representing us. You're Wendy's,
Right. What if the franchise owner? Is there ever a time where like the franchise owner goes under, like their business goes under, but the actual franchise itself, do they ever send somebody like in to take over? Or
that's a great question. That's a great question. And right now you're seeing a lot of the ones that were able to sort of make it through COVID, but now inflation's really kicking in and it's even harder to make money. The franchisees are going bankrupt. There was 4 major Burger King franchisees that went bankrupt in the past 2 months. And yeah, in some cases, corporate will either take over, corporate will force a sale to another franchisee in the area. So if Reggie's doing real good, but Shaka's not, Burger King corporate might say, Shaka, listen, you're either going to sell or we're going to, rain hellfire on you in whatever way we can. And then Reggie goes in and no one knows because it's still a Burger King. So this is all behind the scenes. But if it gets too crazy and they can't find someone, maybe Reggie says, I don't want to work that market. There's way too many purple people over there, or you can't do anything that you want. Then he goes bankrupt, and Shaka's, left dealing with a bank because he probably has a loan on it and makes the brand look bad.
So what would they do in that situation? What does the franchise do if the franchisee goes bankrupt on one of their franchises?
spend money on damage control so that their business doesn't look bad when they have 50 locations go dark.
Gotcha.
Their options are limited. I mean, this is not like a business that operates with robots. You know, you need to have people there to do it, and a corporation can't just snap their finger and say, all right, 50 people we're going to deploy there and 50 people we're going to deploy there. Your hands are sort of tied in a lot of these cases.
Right.
So they're going to do their best to make sure that's why it's so difficult to get into a franchise, but they're going to do their best to make sure that you succeed pretty much.
They're going to help you. I mean, in the cases that I mentioned for Burger King, before it even broke news that these franchisees went bankrupt, I mean, those franchisees are going to corporate and saying, hey, I'm really struggling. We got like 6 months of runway here before shit hits the fan.
Mm-hmm.
Help me out. And corporate will step in and say, okay, well, work with this guy who's going to try and find someone to take over for you. And okay, we'll reduce our franchise fees, right? Because if you're a franchisee, you're going to be paying royalties. So, okay, we'll work with you here. And let's connect you with another guy to negotiate the loans that you have, because that's probably cutting into your ability to be profitable. There's only so many things you can do before it's like, all right, well, none of this worked. Bankruptcy time.
So they try every last option pretty much to keep those doors open if they can. All right.
Yeah, and there's another component here, which is the landlord may not be involved with corporate or the franchisee. In most cases, they're not.
Right.
So, that's another component of this puzzle.
Right. So what would cause a landlord to sell? Let's say if a landlord but before I ask this, is it common for a landlord to own like maybe 10 locations and have the same person lease all 10 locations?
Basic investment strategy says be diversified.
Okay.
Usually private investors will make a concerted effort not only to not have the same franchisee, but not even to be in the same brand, because this is the example that comes to mind, which isn't relevant now, but Chipotle with the E. coli stuff.
Right.
Like, there was a big period there where no one wanted to go to Chipotle, and that can happen like that with social media nowadays. So, hey, you have 10 Burger Kings, even if they're all different franchisees, that brand can go down really quick. So the only time you really see someone have a lot is when they're the pie. Okay, so think of a diversified real estate portfolio as a pie, like any easy thing to imagine. If your pie is really, really big, you can have 50 slices of a Carl's Jr., or whatever, Walgreens. I mean, these are just the brands that everyone is familiar with.
Right.
And that's usually with big REITs or real estate investment trusts, big publicly traded or a lot of money in it sort of portfolios. Private guy, smart thing to do is no. I mean, you should probably own a different asset classes even. So what we're talking about would fall under the quick service restaurant category. There's also like you could think of DaVita dialysis centers. This is, these are all just different things. That's usually a tenant that operates in the space that you'll see transact a lot. And, automobile uses, collision centers, that's another thing that you could, car washes, for example. I mean, all these things, you could really diversify yourself to hedge against whatever comes in the economy.
Right. So in other words, the smaller guys should probably own the building that Wendy's is in and the building that Burger King is in and AutoZone, right?
You're assuming the smaller guy has $10 million to put into this kind of thing. The smallest of guys, if there was to, in this real like passive sort of thing, triple net properties, the safest is probably quick service restaurant. And safety is usually in this space defined as how hard would it be to re-tenant this if the tenant that I have leaves. So on the flip side of that, you could also own like a 30,000 square foot distribution center operating on a triple net lease. That's great. That's awesome. And it could be from a publicly traded company. But the risk in that property comes in the form of, if they leave, can you ever replace whatever rent they were paying? Like, let's say it was a government organization paying way above market. They just really needed that area. So they were able to make double market rents there. And it's a massive space. So who the heck are you going to find for a 30,000 square foot distribution center? And how are you going to replace the income that you had from a high paying tenant? So that's but a quick service restaurant You got a drive-through usually. It's 2,000 square feet or less. That's like, there's a lot of demand for that product.
Right. Is the motivation for the landlord to sell similar to like any other investment property? So, for example, because I'm trying to picture, like, why would I sell something that has a 20-year lease and maybe I'm 5 years in it? Why would I sell that property?
Because you can make more money somewhere else.
Yeah, well, usually it boils down to because you can make more money.
Right.
You have circumstances where brokers will call you, and usually the people that invest in this asset class, when you want to talk about passive, the investors in this product type are usually coming from apartments or office building or much more intensive property types that were potentially making them more money, but they're sick of the calls at night in the apartment world, or they're sick of having to re-tenant things. So, you know, they can get scared really easily if someone like any of us on this call called them up and said, hey, I heard something really bad about Burger King. You should probably get out of this because you're going to be left. This is an 80-year-old woman. We're calling up 80-year-old Betty and saying, hey, I don't know if you heard, but 4 Burger King franchisees just went bankrupt. Those landlords are screwed right now. You should probably sell your property and you should invest in a Popeyes or whatever, you know, whatever it is. That's a common reason why someone sells. On the more sophisticated side of things, let's pretend you have a traditional triple net lease. Traditional is probably not the right word, but you'll see oftentimes a 20-year lease, and every 5 years, the rent goes up by 10%. Okay.
Right.
So if on year 5, your rent goes up 10%, you've just in theory increased value, because just like anything, you're pricing off of the income, off of a return.
Right.
So if the return you bought it for was a 5% at $100,000, someone that's better at math can do that. I think it's $1 million or $2 million, and then it goes up to $110,000. You've just created potentially hundreds of thousands of dollars of value if someone is willing to pay you the same return you went into it for, with a little less term on the lease. So that's usually a strategy people will employ. They'll wait for the rent to go up and then sell.
I got another question too. So I see a lot of times, like, say there's a franchise restaurant there, and then all of a sudden there's like a mom and pop deli or Coney Island or something like that. You know, it's just a smaller business there. Is it typically that the value decreases because it's not a franchisee there, or is it how does that impact the value of that property and the return on investment?
So if you want to give criteria for what gives value in this asset class, there's 3 things. Location is probably the biggest, and that applies to all real estate, so that's not going to be surprising to any of you. Right. The second most important is probably credit worthiness. Okay. And the last most important is the term of the lease, the fixed term, because the people buying this asset are looking for dependable income for the longest period of time they can get.
Right.
But what you're talking about is number 2, which is the credit worthiness. Yeah, that's going to impact the value. Right. If I have Walgreens and I bought it for a 5% return, and I was comfortable with that 5% return because it checked my box number 2, it's going to guarantee me the rent. They leave, and the tenant that I get there is Reggie's Hamburger Shack. Somehow, if you're filling up 15,000 square feet of hamburgers, but you don't have the credit worthiness of a public company, yeah, I'm going to have to offer the private market probably a 7% return now. These are all arbitrary numbers, but yeah, and I mean, in this space, a 7% return from a 5% return, that just equal potentially $1 million+ of value that I just lost. Right. Because I'm not giving people the credit worthiness. That answer your question?
Yeah. I'm asking on behalf of our audience.
Yeah.
So I do want to break that Popeyes deal down though.
Let me pull this up. Let me see if I can share my screen here and get this set up for us.
No problem. So the deal that we're talking about for
a little bit.
Yeah, I got about 10 more minutes.
Okay.
So you can probably stay on this page, and I'll just tell you when to flip through. So this property This is a portfolio of properties. So we're actually going to go from investor right now, and we're all going to pretend that we are restaurant operators. Let's pretend we're all Popeyes operators.
Okay.
And we bought our first property. So we own the property that we are operating in. And we all know what the cost of real estate is. It's expensive usually, and your money's trapped in those walls, the equity. You're not in the business as a Popeyes operator, traditionally speaking, of real estate. You're in the business of selling fried chicken sandwiches. That's where you make your money. So the question is, how do we make more fried chicken sandwiches and sell them? Because that's where we're making the money. And you're like, well, we got to open up more stores, but I don't have any money. I have a mortgage on this property, so I can't get another loan on it. And if I do, it's probably going to be hard money and be way too expensive to get. I don't want to lease another property because I'm not 100% certain about, that market, and I don't really have an exit strategy. So you're like, okay, clearly the issue is all my money's trapped in this real estate. How do you get it out? And the way that most of these franchisees do it is through a sale leaseback. Mm-hmm. They're already owning the property. They want to offer someone on the private market a return that they know they can justify because they've been operating there for about a year or whatever it is. Let's say they've been there. In this case, they've been here for a decade. They know what their revenue is going to be. And if you're a restaurant operator, you don't want to be underwater. So you need to set your rent at a level that makes that store still profitable. So in the restaurant space, in the quick service restaurant in particular, a really easy ratio to figure out what's a safe rent level is 8% of what your gross sales are. And there's traditionally speaking like percentages for each category. So most people know what the labor expense needs to be in order to be healthy, or what the cost of buying your product is to be healthy. But for the line item of rent, that 8% of your gross revenue can go to rent, and you can still be profitable as long as all those other categories are at what they need to be. So you're like, okay, I know what rent I want to set. I know that I'm going to have to be paying for everything else and offering the market a triple net lease. Okay. So you then back into that number really easily by saying, okay, what return can I offer a private investor? And it's a super simple formula. So you figure out your rent, let's say you're making $1 million. 8% is the right number. We're going to set our rent at $80,000. I'm going to call up Jason Pfeffer. I'm going to say, hey, what would the open market pay with all the things considered for my Popeyes property if I signed a 20-year lease at closing, a 20-year triple net lease at closing? So I'm like, okay, well, you're not that good from a balance sheet standpoint. We're going to do 20 years. Here's the lease structure that we would use. I think the open market would need a 6% return. That's what they'd pay you. I was like, okay. So that's $1.33 million. Okay. Yeah. So you just created $1.33 million. And you bought that property as vacant land, and you built that with whatever loan you got. Let's say you're in the property with a mortgage of $600,000. You pay off the mortgage with the $1.33 million. You now have a lease rate that you could support because you set it yourself. And you now have $700,000+ to go and start your next Popeyes, and you rinse and repeat, or whatever restaurant concept we're talking about. But let's call it the sale leaseback method of expansion. And that's what this group's doing right here.
Okay.
So in this case, it's the largest Popeyes franchisee in the country. They're also the second largest franchisee in the country across the board. So they don't just operate Popeyes. And the cap rate category, which you see second to the right. Cap rate just means, in this case, what return am I going to get on my money?
Right.
Cap rate's the net divided by the price. So what's my net income every single year compared to how much I'm going to have to pay for it? Or really simply put, what the heck's my return, if you want to think about it like a bond or a stock? So we can go to the next page, and it'll kind of break down, some of the things.
I think these were the only 3 pages I had.
Okay.
Go back.
Yeah. I just had this one and this one here.
Hold on.
Yeah.
That's by my house.
No problem. We could stick with this. So this is a portfolio. Right. We brought out 5 of them. They picked these 5 because I basically looked over the whole portfolio and figured, hey, these 5 would probably perform the best on the private market. So let's focus on these 5. They'll sell the quickest. You'll get the most money for them. And in their case, they have plenty of money, but from a really sophisticated standpoint, you don't want to use your own money. You guys all know that. Any sophisticated investor knows that.
Yeah.
And construction loans are really expensive right now. Interest is extremely high. So
Right.
in their mind, they're basically borrowing money at the cap rate they're offering. So in other words, they're getting a 5.25% interest rate on whatever money that they get out of this. That's the simplest way to look out of it. So people always call me and say, well, why are they selling? Aren't they doing well? It's like, yeah, but if they could borrow money at 5.25% compared to 7.5%, that just means they're good business people. That doesn't mean they need the money. So that's what's going on in this case.
Because I always learn, try to borrow it when you don't need it. Because when you need it, you usually can't borrow it, right?
Exactly.
Ray, share my screen right quick. Let me share mine.
Okay, we actually did a deal like this, but on a smaller level. Hold on, let me remove this one here. All right, go ahead. Wait a minute. Go ahead and share yours, Shaka.
All right, here I go.
Let me stop my, okay. You should be able to share now. Yeah, we did a deal like this on a smaller level. It was the business owner. He needed some cash, so we brought it from him and leased it back to him. But it wasn't $2 million.
No.
It's
a good deal.
But yeah,
this exists in the house world. This exists in the house world too. I mean, in the most simplest form, if you need to stay in your house for another 30 days, you're effectively doing a sale leaseback.
Exactly. Yeah, and this guy had been in business in the community for probably like 20 years or so, heating and cooling company, and it worked out for all of us.
Mm-hmm.
Okay, perfect. And by the way, I got about 5 minutes, so we'll run through it. Let's keep going. It's going to be the page where we break down the financials of it. Right there is perfect. The executive summary. So, I mean, this is as simple as it gets. If we're talking about retail deals or other commercial properties where you're going to have overhead expenses, those would all be broken out in whatever marketing materials it is. So it would show you what your property taxes are going to be. It would show you what your expenses are going to be to maintain the building, et cetera. In this case, you don't see a lot of that because there is none. When we say passive income, this is truly the closest thing you can get to passive income, short of actually just buying a bond. And people always say, well, why would I buy something that's a 5.25% return when I can buy a bond, which is offering the same thing and it's backed by the US government? Two primary things. Well, you can't do what's called a 1031 exchange into a bond, which is when you sell investment property and you don't want to pay whatever capital gains you have to buy another property. You can't do that into a bond.
Right.
And the second thing is you can't depreciate a bond. So in the investment sales world, one of the primary benefits of owning commercial property is the ability to actually depreciate it. In other words, reduce your income taxes by what the IRS deems to be, I think we all know what the word depreciation means, a loss in value of that property. So the IRS has their formula. They tell you, okay, the building is worth $2 million. You can depreciate X amount of that per year against what your income is. And you can't do that against the bond. At the end of the day, you're going to have to pay the income tax on that no matter what. So real estate's still king in my eyes.
So before you run, in layman's terms, why do you feel like this is a good deal or opportunity?
Well, I mean, you would have to be familiar with the whole market at the end of the day. Because this is so simple, this is just a good return relative to other properties that are similar that you can get on the market. I mean, this property checks off a lot of the boxes that I mentioned. Okay, it checks off all of them: location, credit, and the length of the lease. You have a 20-year lease. You're in Detroit, in a very, very great area for this business. I'm not saying this would be a good area for a Louis Vuitton store, but when you're talking about a Popeyes, this is the right location for it. And then the second, and in my opinion, the biggest selling point is the credibility of this. There is no stronger Popeyes franchisee out there on the market. So if you would have to look at the full picture and see, okay, this property sold at this price, this property sold at this price. And in my opinion, this is priced very in line with what a person should expect to get as a return for this property in today's snapshot of the world.
And if I heard you right, they're not only a solid Popeyes franchisee, they're one of the top franchisees in the country, correct?
That's right. That's right. But at the end of the day, a contract is what matters. And in this specific case, the entity backing the lease. In other words, if this company was to go belly up, who do you sue? It's whatever's signing on the dotted line. And in this case, it is an entity of theirs that holds 155 Popeyes. So that's what's backing the lease.
Right.
You can go to sleep knowing that your rent's not coming, or your rent is not going to come because this store does badly. There's 154 other stores propping up their ability to perform on this lease.
I think with some of the so everybody has to understand that this somebody made a comment about Popeyes and they're struggling. We don't really care because we just own the real estate. I mean, we do care. We don't want it to go bad, but that's not our problem. We're worried about the rent, not about their sales.
Yeah, that would be an issue if you had a percentage rent clause where you're getting your rent not at a set fixed number, but you're getting, let's call it 8% of whatever their sales are. So they would show you, hey, I did $100,000 this month. Popeyes is no good. Oh, shoot, my rent just got cut in half. And,
I got one last question before you go. Why does the 8% matter if you're worried about the cap rate? So does the 8% really matter, or is that a real thing?
It is extremely real. And it goes back to the health of the business that's paying you your rent. So on the flip side, let's say I just wanted to make a shit ton of money as the person who's about to do a sale leaseback.
Mm-hmm.
I could just set my rent extremely high. Let's say I set my rent at let's say my revenue is $2 million. I'm going to set my rent at $2 million, whatever it is. And someone's going to give me a cap rate for that.
Gotcha.
But my business would go out of business in about a week when I have to pay my first rent check. And oh my goodness. So a person who's buying the property wants to know that the business is healthy. And the 8% is just a metric to say, okay, they set the rent level at what we know in the marketplace to be a healthy level. Gotcha. They can operate successfully if the rent is 8%.
So that's just
above.
Oh, go ahead. No, go ahead.
I was going to say, once you get above 8%, let's say the person needs to make $100,000 to keep that store open. Otherwise, they're going to close it because it doesn't make sense to run a whole business and not make $100,000. Whatever it is, arbitrary numbers. Mm-hmm. Every time I increase my rent to sales ratio or whatever my rent is, it's in comparison to my revenue, my sales, I'm eating away at that $100,000, right? So once you get above that 8%, let's say now I'm only making $50,000. Well, shoot, I'm probably leaving this restaurant the second my lease expires. Compared to if I'm buying that knowing they're at 8%, well, hey, at the end of 20 years, they set the rent level correctly. They might stay there for a lot longer.
Right.
Gotcha. So that's a way for the landlord to make sure that the business is healthy. That's why that's important.
Correct.
Gotcha.
It's usually the first question if I don't have it in the marketing package. Mm-hmm. Anyone who's familiar with these properties, what's the rent to sales ratio? Gotcha. And if I say anything above 8, they're going to go, okay, well, I need a higher return because I don't feel comfortable that they're going to stay there. So I need to make more money on the front end.
Mm. So you want a lower rent to sales ratio?
That's the primary, one of the big metrics in the restaurant space. And that applies to you. It has other words like rent to revenue. Even in the Walgreens space, there is like a metric. So Walgreens, for example, you want to be at a 15% rent to revenue. Mm. If their rent is set at 15% of whatever the revenue is, you could say, oh, they're probably making good money at that store.
Makes sense. Appreciate you.
I got 2 more minutes if you guys have anything else. It was a pleasure, by the way. I really appreciate the opportunity to talk to you guys.
But what makes this even more attractive too is because the person buying it is not necessarily paying cash. They're probably financing this as well, right? Or
not so much. Right? Well, right now you'd be negative leveraged because interest rates on this product type are about 6.25 to 6.5%. So unless you're putting more than 50% down, your cash flow is going to be, your ROI is going to be basically nothing. These are usually people that are selling their apartment buildings and 1031 exchanging into this, and they're used to getting like a 3% or 2% ROI because they've owned their apartment buildings in Los Angeles or New York for 30 years and they can't increase the rent anyway. And they're like, all right, well, I'm making 3%. I'll be happy with 5.
Okay. All right. That makes sense. All right.
Okay. Appreciate it, Jason.
Yeah,
thank you guys so much.
All right.
Take care, everybody.
Come with us again. You're a pleasure and you're super funny.
Take care.
All right.
All right. Yeah.
All right. Deal or no deal?
No deal. But I ain't rich enough. I mean, it's out of my, you know what I mean? Like that's a passive. So what he was explaining, that's why he used that 80-year-old lady, right? She not out here hustling. So we still hustle. We still work with our money. You know what I mean? We put it in places, but we still actually work. An 80-year-old woman that's got a lot of money, she ain't trying to hustle or do no work. She just want to put her money somewhere where she got her guaranteed return. That's why that return, that 5.25, that's low as hell to us. Like we make way more on, shit. If we had 2.5 million and we probably would make easily 25%, easy. And I'm just going low, you know what I mean? So yeah, we're not,
like 25% and 4 points at least.
I like it for somebody that's in that space already, because like he said, it's usually for somebody that already got their money in investments like this, and they sold something and they're just rolling it over to this, and they're probably getting a better return on this than what they were getting before. And you're not trying to, this is for somebody that's not out flipping houses or doing, a couple hundred residential.
Real
passive. Yep.
Yeah.
And the more passive it, like we said on the show, the more passive it is, probably the lower your return is going to be. But it's probably safer too.
Lower risk, low return, right?
Right.
Sonny J was talking about the business going belly up again. So he talked about that, Sonny J, when he was talking about that rate on rent or whatever he called that term. What did he call that? Hold on. So although you might feel that way, Sonny J, if they're in that 8% or lower, like he explained for that Popeyes, that's not really a fact. Just that just may be your perception of what you see happening with Popeyes. That doesn't mean that's actually going on.
Yeah, because
I'm trying to figure out, like, Popeyes, not like some of these other restaurants out here. There are always lines wrapped around the corner. You got to wait an hour for a chicken sandwich or a meal or whatever. I haven't experienced any of the Popeyes where it's just like a dead zone.
Even the one on 8 Mile that where everybody was talking about is the worst Popeyes in the world. That thing is still
go there. Yeah,
that thing is still going crazy.
I love
Chick-fil-A.
Yeah, Chick-fil-A, I just don't think they don't have enough locations compared to Popeyes. Popeyes have a larger market share. Chick-fil-A has a better product and better customer service, but Popeyes still slap.
Yeah,
there's always
people gonna wait, and they're gonna get that customer service and that chicken at the end of it. Like, because I do it all the time. I'll be ready to fight by the time I leave that drive-through. Like, I got my chicken.
Yeah.
That was a good one, y'all. That was a good lesson. He explained very well everything that he talked about, and that is a different game right there. That's a different game. I guess that's a game to aspire to get to.
Yeah, that's what you build up to. Once you want to sit down, you didn't accumulated your money and you got your money just out there. Because I mean, you can live off of that income pretty good when you get of age. And if that's where some of your money parked, that's a good retirement plan.
What they say, that's 136 a year. So off of that 2.5, but you're not doing nothing to get it.
Right. But most of the people he's talking about, that's probably not their only 2.5.
Yeah, he low. That, like, because he watched that our passive income episode, but because he's like, this is like one of the most passive ways.
Yeah. And you talking about a 20-year lease, like when we talk about, generational wealth and all that, and you talking about a tenant that's going to stay there 20, 30 years, that's easy to pass down to your kids because they really don't have to manage anything at that point.
Mm-hmm. That's like the one we did. I mean, it's on a super micro small level.
But ours, I bet you our return is way better.
Our return.
That's what I was going to say.
Our return is not no joke. Like we did a really good job on that deal.
Yeah.
Yeah, we did.
Yeah.
We did.
So, but I'm just saying, like, for the idea of it, like the amount of work that's put into it, for an owner that needs someone to come over, give me this money for it cash, and, you're going to recoup that return. It's pretty clean. Because they already have the longevity and the long standing of maintaining the space already.
I didn't get to ask one question. Let me show y'all something. It was one question. It looked like the lease about to end in 2 years.
I didn't see that.
Hold on, let me see. That's my screen?
Yeah.
How the hell do I get back to it?
What up, Emmett? What up, Rhonda? Who else came in on the chat? Rhonda, you said Sonny J, and Aaron said Shaka, what up?
What up, though? Where did I see that at? Hold on. Right here.
I probably would like this over an apartment building right now.
Maybe that's the year built. Maybe you see where it says year built upcoming remodel?
Yeah.
I don't know if that means that's when they're gonna shut it down, or is that the end of the lease and they about to start over? But it
no, the lease, you're gonna get a new lease because they're asking you to buy it and lease it back to them. So you will have a new lease with them. That's why they're selling it to lease it back.
And that term.
So this about to be over then. So you saying it's about to be over?
No, they're not. They currently own this. They're selling it to somebody so they can lease it back from them. They're raising capital, basically.
Oh, right.
Yeah, and they're willing to do a 20-year lease, and then they're saying that they're gonna remodel the building in 2 years.
So in order to do that, the person that's the landlord is selling.
The owner is selling. Just like the deal we did, the owner sold it to us and leased it back. Just imagine if the person we're leasing to, if they made improvements on the building or they remodeled it. It's
so you feel like the Popeyes owned their own building? They wasn't leasing it?
This franchise, he owned it and they're selling it so they can raise capital, and then they're going to lease it back from whoever buys it.
Oh.
And then it's not just this one location. Is it all several of those locations?
Yeah, it's several locations on here.
5 of them or something.
Yeah, and so this is the thing. Like, if anybody has watched like that McDonald's documentary, that's the one thing I do like about this package is that you're buying land.
Right.
Like
1, 2, 3, 4, 5. Yeah.
So everybody, y'all go talk to some people and raise some capital and go do the deal.
Raise 2.5.
I'll do it for 11%.
I would not touch this deal. I mean, right now I'm not old enough and I don't have enough money to do anything with this. This deal is not appealing to me in my current bracket of my current income bracket.
I like the deal if I had the money to do it.
How much money would you have to do it? If you had 2.5 million, would you put it in this, or would you do something else?
Not me at this age right now. I wouldn't.
Oh, okay.
Yeah, I
would need to counter. I would need to counter their offer. I would need to get about $350 back.
I would loan Emmett. The money and go buy some houses.
I mean, the problem is we know. I mean, we could earn way more money on that 2.5 million right now. So we're not.
That is true. If I had $2.5 million to go and invest, I definitely would not be yielding a 5% return on it. Absolutely not. Like when we were talking about it earlier, I swear that I'm pretty sure we could do 25% with our eyes shut on that.
Yeah, I feel like
and that's because we're at the age we're willing to take those risks. Like you said, this is somebody that probably, if you had 30 million sitting around and this was 2.5, and you could go invest the rest of the money somewhere else and get a higher return, but this was a little bit more of your safer money, you probably would do it then, so.
Yeah. If you diversify, you had 200 million and you put your little, you say this for one of my kids or whatever, for their college savings or whatever the hell it's gonna be for it. Yeah, you put that to the side, they good. They got, they got 130 coming in off of that little investment. Yeah.
Yeah.
Low risk. But all right, y'all.
You're right.
Good show. Good talk.
Yeah.
That's right. Thanks for joining us, y'all.
Yeah. All right, y'all have a good one. We'll see y'all next. Oh, y'all like, share, subscribe on YouTube and all the platforms. And go check us out on Spotify, Apple Podcasts, and Breaker, Google Podcasts, and all them other platforms as well. All right, we out.
Peace.